I'm Vanessa. Joining us is our co-host MEIA, our monetary economic insight assistant. Wah, 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 MEIA.
Glad to be here, providing data-driven insights to our discussion.
Okay, so we're going to break it down with an analogy. Think of the economy as a car, and the Fed is the driver. When the road is smooth and traffic is light, the driver might accelerate to maintain momentum. But if the road becomes foggy or slippery, like with unpredictable trade policies or inflation, the driver eases off the gas to maintain control. Right now, the Fed is navigating through dense fog, cautiously adjusting the speed to keep the economy on track.
So let's dive into the Federal Reserve's recent decision. On May 7th, 2005, the Fed announced it would keep the federal funds rate steady at a target range of 4.25% to 4.5%.
As Vanessa said, the Fed sets the federal funds rate currently at 4.25 to 4.5. This is the rate that banks charge each other to borrow money overnight. It's like the base cost of money in the U.S. economy. So banks use this as a starting point. When a bank offers a mortgage, they look at the federal funds rate, their cost of doing business, the risk of lending to the borrower, and their desired profit point.
So if you're seeing mortgage rates around 7%, part of that 7% is based on the 4.25 to 4.5% federal rate. And the rest, about 2.5 to 3%, is the bank's markup to cover profit, risk, admin costs like paying employees or having additional paperwork, etc.
So it's not a guaranteed 2.5 profit. That margin also helps banks hedge against economic uncertainty or loan defaults. So it's more of a spread than pure profit.
In short, the feds set the base cost of money and banks add their margin before offering you a rate of 7% for a home loan.
This marks the third consecutive meeting where the Fed has held rates unchanged, signaling a cautious approach amid the economic uncertainties.
Inflation has been a significant concern recently after peaking at 9.1% in 2022. It's now down to 2.3% as of April 2025.
So even though inflation slowed down to 2.3% in April 2025, that doesn't mean that the prices are going down, just that they're not rising as fast. Inflation tracks the rate of price increases, not the actual cost. So after prices surged in 2022 and kept rising through 2023 and 2024, we're now paying more than ever, just with slower increases.
So groceries, rent, gas, they all feel very expensive because they are. We're living with the cumulative impact of 3 years of inflation. Slower inflation just means prices are climbing more gently, not that they're dropping, which, mind blown.
Yeah, because when I read 2 point, whatever percentage, I was like, oh, okay, but no, everything is still expensive.
Mm-hmm.
So yes, in many cases, the higher prices we're seeing are the new normal. Yeah. The new normal. Once prices rise, they rarely go back unless demand collapses or there's a major oversupply. Businesses are now paying more for labor, materials, and rent, and those higher costs are built into what we pay. Many of these things we spend on, like rent, insurance, and meals, have sticky prices that don't easily fall, even when the inflation slows.
On top of that, companies raised prices during 2022 through 2024 to protect profits. And now that consumers have adjusted, there's little to no incentive for them to lower them. Unless there's a major economic shock, prices are unlikely to return to pre-2021 levels. This is basically our new baseline, unfortunately.
However, the Fed remains vigilant. The minutes from the May meeting reveal concerns that inflation could persist longer than expected, especially with recent tariff implementations.
Indeed, the Fed's statement emphasized that uncertainty about the economic outlook has increased further, highlighting risks to both employment and inflation.
Political dynamics are adding to the complexity. President Trump has been vocal in urging the feds to cut interest rates, arguing that high rates disadvantage the U.S. economy.
Despite this, Fed Chair Jerome Powell reaffirmed the central bank's independence, stating that monetary policy decisions are based solely on objective economic data.
On the employment front, the labor market shows resilience. The unemployment rate stands at 4.2%, with employers adding 177,000 jobs in April. Yet, there's an uptick in jobless claims, indicating potential softening.
Market reactions have been very mixed. The S&P 500 showed volatility following the Fed's announcement, reflecting investor uncertainty.
Looking ahead, the Fed's next meeting is scheduled for June 17 to 18, 2025. While some anticipate potential rate cuts later this year, the Fed has indicated a wait-and-see approach, closely monitoring economic indicators.
The Fed's commitment to its dual mandate, maximum employment and price stability, remains steadfast, regardless of political pressures.
All right, so we've reached our
Recap. Yay!
Prices feel high because they are. Even though inflation has slowed, prices haven't gone down. They've just stopped rising as fast.
Once prices go up, they rarely drop, unless there's a major crash in demand or a sudden oversupply. Elevated prices tend to stick.
Business costs have increased. Higher wages, rent, materials, and transportation have pushed up the baseline costs of goods and services.
Some prices are sticky. Things like rent, insurance, and restaurant meals don't drop easily even when inflation cools down, which is a huge drop, 9.1 in 2022 to 2.3 now, and the prices are still high. Oh my God.
Companies raised prices during 2022 to 2024, and now the consumers have adapted. There's little incentive for them to lower those prices.
We're living in the new normal. Unless something drastic happens, prices won't return to pre-2021 levels anytime soon.
Slower inflation means less pain, not lower prices. We're still paying more than we used to, but the pace of increase has softened.
Now is the time to plan smart. Build a budget based on today's real costs, trim waste, and negotiate where you can.
The Fed is holding rates steady. They don't want to cut too soon and risk reigniting inflation or causing another economic mess.
This steady approach is strategic. The Fed is trying to let the economy settle without causing chaos, knowing it's safer to move slowly than to overcorrect in the future. And that's all for today's ChisME segment. Stay informed and join us next time as we continue to unpack these Fed talks. I just realized that's really close to TED Talk. The next one is June 17th and 18th, so stay tuned. Give us a like, a follow, listen to us on Instagram, Facebook, YouTube, wherever you listen to your podcast, give us a follow.
Thanks for tuning in. Stay tuned for the next episode where we will do a deep dive on the impact of federal interest rates and on how money circulates in the economy. Remember, stay focused and motivated and you will reach your goals. If you have any questions, send them to questions@moneyelementary.com. Share this knowledge with your friends and family because knowledge is power.
Toodles. This is money.
Money.
Oh, we're off today.
Elementary, yeah.
Didn't know what you were doing. Money Elementary.
Money Elementary.
Yeah. Bye.
Bye. Hi, everyone. We are here at Money Elementary, Heidi and
Vanessa.
we want to clarify a few things before somebody gets the wrong idea.
Or a bad idea. And as exciting or boring as it may be, please listen through all of our legal disclaimer information so that you understand up front that in this podcast, Money Elementary, we are not a financial advisor. If you need advice, go to your accountant,
CPA,
stockbroker,
real estate agent,
psychiatrist,
psychologist,
loan officer,
therapist,
financial advisor,
or a credit analyst.
Nothing said during Money Elementary episodes should be construed as advice.
We're just two sisters who like to talk about all the S that we've been through and who've learned a few things while attending the school of life.
I can't wait to graduate.
Oh no!
Just kidding.
That's the funeral. Well, that took a dark turn fast. Anyway.
Just two cute savvy sisters with a decent internet connection.
A microphone.
A computer.
And
way too much time. What? We don't have that much time on our hands.
No, we don't.
But bottom line, all the content we share with you guys is stories of our true life experiences, shared anecdotally, and is meant for informational and entertainment purposes only.
We couldn't make this stuff up even if we wanted to. We hope you enjoy the information we give you and our show.
Thanks! This is Money Elementary. Woo!